That being said, let's start with our question from Paul that came in prior to the webinar today from email. Paul's a regular on our Friday sessions, and he wants to know, some options traders say that they plan to buy a long call today and later sell a call against the position, so legging into a spread position. What is the best way to analyze whether to create an immediate spread or to leg into a spread later? The direct answer to your question, but I'm going to go through some various points on this, but the direct answer, of course, is expectation. In this case, from what Paul sent to me, talking about buying a call now and selling another call later, we're naturally only referring to a bull call debit spread, where we would buy a slightly in the money or maybe even at the money, but I'd prefer to buy an in the money call, say 20, 30 days out in time, and I'd sell a higher strike call against it. This is a parity trade to a bull put spread, or you could even look at it as a collar spread, has the same risk reward profile. They have the same expiration, and of course on the same stock. But the idea of legging in is I'm going to buy this first, and I'm going to wait to sell this call later. I would only do that if I have the expectation that the stock is going to move up, and I have confidence in my criteria to select a stock that's going to move up in a certain time frame. If the stock stays at the same price, let's say the stock was trading between the strikes when I did this, and it stays the same, doesn't move up, well, I'd have been better off entering the spread immediately. We'll talk about why in a moment. The diagonal spread or calendar spread, same principle, but I'd be buying a call that's maybe 70, 90, 120 days out in time, buying a call option slightly below the stock price, and then looking to sell a call that's at or slightly out of the money. In the legging in concept, I buy this first, wait a week, maybe two, and if the stock moves up, I'd expect sell this for a better price. So how would you analyze doing it? The direct question, how would you analyze doing it straight away or legging into it? Well, it based solely upon your expectation of, do you feel confident enough the stock is going to go in your desired direction in the first 7, 10, 15 days, depending even on what your expiration cycle is. Now, would today be good? Well, there might be some opportunities to buy calls on a stock that looked like it was having a sort of upward trend. I can tell you exactly, yeah, this stock is KMB, Kimberly-Clark, had the trend, here's some news, here's some headline news, had the trend and the rebound, here's some headline news about tariffs and so forth. Here's a little glitch that happened in the industry, had the trend, and here we go again. Okay, that's all this is for this particular stock. It wants to be doing this, but it's getting interrupted. Okay, so here we are at an interrupt. Is it a good idea to maybe buy a call today thinking that next week the stock's going to move up and I can get a better premium? If I'm right, yes. If I'm wrong, straight answer is no. All right? A bull call debit spread 1 month out on this position. The stock was trading, it was bouncing around when I was taking these screenshots, and I apologize for that, but KMB trading around 138.50. I might get away with buying a 136 call for September standard expiration, about 35 days out in time, a little bit more, 38 days out in time. That would be 430. At the same time, I'm going to sell the higher strike call at 310. This gives me a low debit of 120. And if the stock's trading above both strike prices on this bull call debit, what happens? Well, I am either assigned at 138 and I exercise at 136. I get 2 points back. We make an 80-cent profit against our risk or debit of 120. Or I could just sell to close the call and buy to close the other call. I did that reverse, but I could sell to close the 136, buy to close the 138, and get close to that $2 back for the 80 cents maximum profit. Okay, now, why would we wait to leg in? Well, again, it's because maybe I think in the next 5, 10 days, KMB is going to go up 3 points or so and be trading around 141.50. If that's the case, the 130 call might be priced at 450. This would actually give me a debit. I'm sorry, it would give me a credit. I'd now have a bull call debit spread structure done at a credit. I don't have to put up any margin requirement because the call that I bought is lower than the call that I sold. The 140 call, 2 points higher, might be priced at 326. I use the Black-Scholes calculator on the profit and loss chart on power options to figure that out. So this wouldn't be done at a credit, but the return, the max return, is peaked at 2 points higher at 140 instead of 138, and my debit would be 16 cents lower. This would almost take that return from 60% up to about 120%. We double the return if the stock now stayed above 140 for the remaining time. I increase the return. I lower the risk. It sounds fantastic. Now, the same would be true for the calendar call. I might buy the November 135 call for a price of $7.55. Sell that same September near term, gives me about 3 right cycles, so I could sell in September, October, and November. K&B does offer weeklies. Let's keep this simple and just talk about standard expiration. So I might have 3 right cycles here against my November 135 call, including the November series. Good return of 52%, debit of $4.45. Again, if I wait 5 to 10 days or so and the stock moves up as I expect, the 138 call might be priced at $4.51. This would drop my debit down from $4.55 to about $3.05. Fantastic. The peak return would be much higher. The 140 call would go up to $3.26. 2 points higher than my obligation of the original calendar spread at 138, and a debit of 16 cents lower. Not great, not an extreme debit, but the real benefit here is this higher strike, giving me more oomph, more return. All right, so the old versus new. Here's the original K&B bull put I could have opened today before the close. Only about a 55% probability. I'd probably go deeper in the money with my bull put credit spread. Out of the money it would be, or my bull call debit spread for higher probability but lower return. If I waited and everything worked out correct and the stock was up at 140, 150 and I sold the 138 then, now we're in that credit of 19 or 20 cents, guaranteed profit, no chance for a loss, and we take the return up from about $75 max, $80 I believe it was, up to about 210 or 220. Now just remember, the stock's going to be trading up here, so we've got a better probability. Great benefit. On the calendar spread, you see here we have this, yes, if I open that original calendar spread, I do give up a lot because I'm right at the money. So if the stock started to move up, I might even have a second upper break even if the stock really shoots up in price. But if I wait, get the price I want for the 140, I don't really have a chance of loss on the upside. We take that maximum profit from, I don't know, about 220 or so, theoretically, on the first right cycle up to about 340, 350. Benefits abound. Lower risk, higher return, maybe not even a chance to have 2 break-evens, an upper and lower break-even on the diagonal spread. So what does this give us? It gives us the best of both worlds if you are right. On this note, if we think about it, talking about bull call debits, bull put credit spreads, and more, we'll get to those combinations when we talk about Earl's question here in a moment. I would love to enter a credit or debit spread that have the same month expiration, where the sold option is overpriced or overvalued, and the option that I'm buying is undervalued. Well, yeah, but if it's on the same stock and it has the same expiration, if one option in that cycle is overvalued, the other ones are going to be too. Now, the tools on power options will help you identify positions if they exist in the vertical spread where your short option is overvalued and the long option is undervalued. But on a vertical spread, that's very difficult. This is a wish list. I would love to leg into a spread that I'm planning on trading that did go in the right direction. I get more bang for my buck. That would be fantastic. But again, you see, it's part of a wish list. I would love to enter diagonal spreads where the sold option, the option in the near-term expiration, is that its peak implied volatility. It's the highest it's going to be. And the option that I'm buying 2 months out, 3 months out, maybe 5 months out, is at the lowest implied volatility it is right now as well. And of course, I'd like to be able to time my diagonal spreads perfectly, where I sell the call when the stock's at a recent high, buy it back before expiration when the stock hits a recent low, wait for it to come back to the next high and sell that call again against my long that's sitting out there in time, and then buying back at the next low. This is my wish list. The legging in is part of a wish list because if we're wrong, we've entered a long call where we have no hedge, no premium in to help counter the loss on the debit or on the long option we're holding. In the case of KMB, if I'd opened this position 2 days ago, opened, say, a long call 2 days ago with the hope the stock was going to continue the trend and it fell today, now I have to may settle for selling a lower strike call for a lower premium just to get something back. And if the drop was too steep, I may be selling a call on that bull call debit spread we plan to go in our direction that's lower than the current strike. I'm actually in a bear spread now that's going to require margin. And on a day like today, if I'd opened it a few days ago, I'd opened that long call when I thought KMB was going to continue up in price, and then out of nowhere, the headline news hits us again. I could quickly be at a 50, 60, or 70% loss on the long. Okay? How often are you right on your stock selection for any strategies you've been trading that the stock moves up 2 or 3 points, moves up 1 to 3% in the first 1 to 10 days? If you're confident enough in that, legging in could work for you. But if you're not confident in that and you don't have a good track record of at least 60, 65, maybe 70% of the time the stocks you select to move up 3 or 4 points in the first 3 to 4 days, I don't think legging in is going to be a great idea. Here at Power Options, we do, of course, develop default criteria for all the searches: debit spreads, calendar spreads, bull puts. And Ernie and I spend time back testing these to find which one best suits our trading plan. You hear me talk about this on a regular basis. Those bull put weekly default searches, it's between an 83 to 87% success rate per year, 15% average on the winners with an average of about a 48, 49% loss with the management techniques we use. It's a trading plan designed for investors who come in and say, well, look, how do I know when to get into a position? How do I know when to do this? How can I maximize the return on this? And the idea is we try to make it a little bit easier and say, look, this default search, the picks of the day and the covered calls or naked puts, the default search in the bull puts and in other strategies is designed that even without strict management and the fear of rolling or managing or adjusting or changing a credit to a debit and so forth, even without that, finding a set of criteria that can still be successful long term. That's what we're looking to do. That's what we have sort of programmed in the background. Every market's different, sometimes a little bit lower, sometimes it's a little bit higher. Any strategy we need to enter, we have to have a trading plan. And with the legging in concept, we now have to discuss not only what stocks are you looking for that you're directional on to begin with, bullish to neutral. That's what we're talking about here. More bullish than neutral, actually. But now enter in the legging in concept. Now you have to develop what is the gain you're looking for in the underlying security before you sell the new call. What is the target for the total debit or the total return on either the calendar or on the bull call debit, assuming it goes in your right direction? What is the management approach and the trigger points to close or adjust if it does not go as you planned in the first 5, 10, 15 days? What is the exit strategy if you're wrong too often or the market turns against you? We get more of this headline news factor and you find out that actually 55% of the time the stocks are not going up the 2 to 3 points, or let's say the 1 to 3% you expected in the first 10 days. And are you going to base these triggers on selling the call at a later date on the stock price, the option price, technicals, a gut feel of how the market is performing? These are all things that would have to be factored in to try to develop a trading plan for the legging in strategy on a debit spread, credit spread even, or perhaps, of course, the diagonal spread. It sort of complicates the issue. You're going to have to watch the market more often. You're going to have good confidence and good track record in your signals. And not only in your signals where you're finding stocks that see that 2 to 3 point gain in the first 10 or 15 days or so, or 2 to 3%, 1 to 3%, let's call it, but that after that even the trend still continues. Because even if I did leg into that bull call debit spread example we saw, it'd be great because I got in at a credit now, and there's no risk to the downside. But if the trend reverses, I made 20 cents on it. That's a third of the maximum return I was expecting if I had opened the debit spread from the beginning. Of course, we would have lost on that one too. We would have lost and not had the 20-cent gain. So it's beneficial. But in either case, you still want the trend to continue. And you're going to fight time decay. So yes, I looked at the Black-Scholes pricing model and assumed on KMB if everything stayed the same. And around September 5th or September 6th, the stock moved up 3 points to 140, 150. What would the prices be for that call to sell that we were analyzing? What could we get the benefits from if we sold it then? And that's right. But if the stock that you're entering now stays the same or just moves up a little bit, you're going to start seeing time decay not only on your long option, but on the short option you were hoping to sell. And we went up. We didn't peak near peak as we've been recently, as we were last Wednesday when the VIX spiked up almost to 22. We did see some movement in the VIX today, but we're near an IV high. If the market starts settling down Monday, Tuesday, Wednesday, it starts to move back up, the implied volatility is going to start to pull back again. So you're going to be fighting an implied volatility decrease, and you're going to be fighting time value as well. That'll also come into play. I would never do this legging in concept on a weekly spread, something that's 4 days out or 5 days out. There's not enough time. Sure, the stock could pop 3 points tomorrow and you'd be looking pretty good. You entered the call today, Friday, at the downturn. It does pop up 3 points as you expect on Monday. You could sell maybe the 138 or 139 call then and still get a good premium. But you've only got 4 days of time value left. It's going to start decaying rapidly if you only see a 1 point move on Monday, 50-cent drawback on Tuesday, 1 point move or $1.50 move on Wednesday, and now you're stuck. Okay, you're in a position where you've got nothing to sell, and you might not have any gain on that long option because it's still decaying too. And never leg into a spread position. And Paul, you didn't ask this, of course, and I'm pretty sure you would never do this from the conversations we've had, but for everyone out there, never leg into a spread by selling the short option first and then waiting to buy the long at the cheaper price. You're in a naked option at that point. You're going to have a lot of margin to cover the position, and things can go against you quickly. We are now losing on a naked call or losing on a naked put position. So that's my opinion there. Without direct numbers, let's take a look again. There are opportunities where you could be right and where you could be wrong. Okay? And you see it here, going back with 3 months here. If I saw this first MACD crossover and the stock moved above the 20-day moving average and popped above the Bollinger Band here, I could buy the long here. 1 to 3 days later, yeah, we're up almost 4.5 points. Sell the 138, 139 here. You might have that no risk bull call debit or that. But then, unfortunately, the trend reverses. If I had entered the bull call debit here and it went up as I expected, hey, I still could have get caught and this could still be a loss. This would have helped you. But again, if I did it here on either situation, I'd be losing. And then we see a good target here again, once more, that crossover up above the 20-day, hitting on the upper Bollinger Band. We get in hopefully here. We may have had the opportunity to sell it here, but today, of course, we're hurting in either case. I'm not saying every stock is like this. I'm not saying this is in this direction, okay, that every stock's going to show this pattern. But I'm just trying to illustrate that you can see how you could win and lose with both ones in this direction. And yes, if you timed it right, you would have been better off buying here, selling the call here, rather than entering the debit or calendar spread on the initial date. If you timed it right here, I wouldn't have bought it here anyway, but if you bought it there and then sold it here, legging into it, you'd be better off than had I just got into here. Get that next pullback. Again, we just saw it here and here. If you legged into it, you'd be better off if you waited 2 days and legged in, but we're both hurting here. Okay, so it comes down to timing and your confidence. Okay, and let's see here. Let's take Earl's last question first, and I might have to take Fernando's. Okay, Fernando's, I'm going to take yours after Earl's other questions, but Earl, I'm going to take your third question first because it relates to our topic. And Earl says, if our timing is so good legging in that we get a credit on a debit spread, does that limit Any other gain, or can we still get the width of the spread? Oh, no, you still get the width of the spread as profit, Earl, if you did that as a credit, if you legged in, if your timing was great and you could leg in. Let me go back 3 slides. I know you guys, some of you have commented you don't like scrolling backwards on the slides here, but sometimes we have to do that, and that's to answer the question. So, Earl, here was our original debit spread, and if memory serves, 310 and 430, the debit was, oh, it's right in front of me. The debit was 120. Okay, that was the maximum risk. And it was only a 2-point spread, remember. So if the stock moved up, stayed above here at expiration, we get the 2 points back and we make 80 cents profit on the 120. And that was about that 66% return. Okay. In the case of we waited and we were able to sell that 138 at, this was 410, I believe. So we sold this at around 430. And so we have a net credit of 20 cents. Well, it doesn't change the dynamic of the trade. If the stock's still above 138 at September expiration, I still can buy stock at 136, sell it to 138. I get $2 back. So we make $2.20 on a net credit of 20 cents where no margin was required because this is lower. It's still a debit structure. This is still lower, so we don't have to put up any margin. So the return was really high. It showed at 120, but when you do the math on it, it's really strange because our risk, worst case scenario, is 20 cents net credit. And it's a fantastic way to trade if you catch the trend right and then the trend continues. Okay? So back again to the main question from Paul, how do we analyze whether I want to leg into the position or whether I want to enter it right away? It comes down to the trend. It comes down to your expectations of, are you confident that you're picking stocks that are going to do this? Because now if it doesn't do what you want, you've got to actively manage that long call. You may have to sell a call you did not want to sell at a lower price. I'd use things that, I use as far as, did I go through that slide already? I apologize. Maybe I didn't. Maybe I still had one more slide left and I should get to that now. Let me take a look here, folks. I did. My apologies, Paul. There we go. All right. So once again, to the direct question, what is the best way to analyze whether to create an immediate spread or leg into a spread later? How confident are you that you're going to get that 2 to 4% movement, 2 to 3 point movement in 3 to 10 days? Okay. In addition to that, what is your track record of picking stocks that have done that? That's where the confidence comes from. As I've mentioned before in other webinars, other live webinars that were related specifically to stock selection for radioactive trading and of course for other strategy selections we talked about at the beginning of the year, I would look for stocks personally that maybe had a recent MACD crossover in the last 3 to 4 days and are maybe pushing above the 20-day moving average and going near the top of their Bollinger Band. In a webinar I think we did in January, I showed that this works about 65% of the time. The criteria that I use for sort of my married put selection and the trends I look for, 65% of the time, a little bit more, maybe 68% of the time, the stock moves up 3 to 6% in the first 30 days. That's my target for a married put, where the call, or the put, excuse me, is 5 to 6 months out in time. Really, for me, it's about average of 7 to 8 months out in time. Here's the trick. With what we're talking about on a bull call debit spread or on a calendar spread, I'm mentioning that this kind of concept worked for me about 65 to 68% of the time with about a 3 to 6% gain in the first 30 to 40 days. Well, sometimes that happens in the first 10 days. Sometimes that happens on the 25th day, which is way too late to sell the higher strike call now. My long call might be at a profit, but I'm too close to sell the call now. I'm just going to sell to close the long. This is part of that trading plan you'd have to have with this legging in idea that just complicates it a little bit more. It's adding other layers that you have to plan in to make sure that you're successful long-term, to try to plan to be successful long-term. We all want to be successful long-term, but that's sort of the concept. That's what I would look for. What is the best way to analyze it? What's the best way in your mind to analyze a stock that's going to move up 2 to 3 points in the next 1 to 10 days, or maybe 2 to 3% in the next 1 to 10 days with buying a call that's 20 to 30 to 40 days out in time? Okay. How comfortable are you with the long call by itself in this headline-driven market? It's not to say that we wouldn't both lose. If you bought the call hoping to sell the call later, we did it yesterday, Paul. I enter the Bull Call Debit spread with a little hedge on it. We're both losing today. Okay, that's just the nature, unless we did it, of course, on an inverse ETF. But again, that's what we're talking about. How comfortable are you with the long call? Confident are you in picking the stocks that move up in that time frame? Here's a brief suggestion on what criteria you might want to use related back to other webinars when we talked about the success rate of doing that. And that's really all I can say about it. With my bull put spreads that I use, the 2 or 3 spreads I open using the bull put weekly search, usually every Monday looking 2 weeks out in time for that expiration, I don't want to leg into it. I'm opening it because I have that sort of plan in mind, that trading plan, that success rate where I'm looking to not do as much management and not overthink it. I'm not going to call it a fire and forget strategy because I do have to make adjustments, especially in these types of cycles. Headline-driven news once more. But that's what I'm trying to accomplish, is simplify it a little bit rather than trying to maximize returns consistently by overcomplicating it. That's my personal opinion. You don't have to agree with me. You're an avid trader. You and I went through discussions, and I'm not trying to call you out directly, Paul. You and I went through discussions over the years of doing weekly collar positions, and I apologize, trying to do weekly calendars. And you watch the market, and you were looking for triggers to roll and adjust and to maximize the return, and you're asking the right questions, and you're doing the right things for your portfolio. I 100% support what you're doing. But for my discussion, the best way to analyze whether to create an immediate spread or leg into a spread later is how much benefit do you think we're going to get by developing a new complicated trading plan that has multiple legs going, as opposed to just doing the vertical spread by itself from the beginning if you're having a good success rate with just the vertical spread by itself. That's my direct answer, and that's where we are today. So that's what I feel is the direct answer there. I love the question. And again, one last time, the benefits of legging in, you saw it, are twofold. Lower the risk by getting a better premium, increase the return, what we all want to do. Maybe even have a no-risk, bulletproof debit spread that's entered at a credit. But now we have to ask ourselves, how consistent can we be with getting the stocks in the right direction at the right time, as opposed to how successful would we be on those same stock selections if we had just opened the debit spread from the beginning with getting a little bit of the premium up front to hedge the maximum loss, as opposed to opening a long call that has 100% loss without the hedge in place and then trying to catch it later.